Hi believers, this is Amit from our team, and I'm here to provide a weekly bite and the road ahead in the markets. Nifty closed to all-time high, but broader market consolidation continues. Markets ended the week on a positive note, with Nifty and Bank Nifty rising 0.6%. Sentiment was supported by expectation of progress on an India-US trade deal, although gains were capped by weak domestic macroeconomic data and subdued global cues. Meanwhile, the broader market underperformed as small caps declined. Please remember, stocks after top 200 market cap companies are defined as small caps. Hence, we have over 1000 stocks in small cap. Let me mention few interesting observations here. Over the past 2 weeks, US and European markets corrected approximately 5%, while Nikkei has corrected more than 8%. In the meantime, Nifty 50 has rallied 3.5% over the past 2 weeks, underscoring relative outperformance. Even though Nifty is near its all time high, the broader market is undergoing a consolidation with extremely low level of activity. Both the buy as well as sell volumes are at historic low, with majority stock trending downwards. There are pockets of market that are doing well, ranging from public banks, autos, and shipbuilding companies, few food companies, and limited alcohol companies. In the absence of broad-based market, it's the individual stock that must have done well, driven by their own respective triggers. As such, a bottoms-up investor would have done much better this year compared to the overall market. So it's turning out to be extremely selective stock-specific market. Hence, you must be seeing your portfolio in red most of the time. On the global front, Japanese bond yields spiked suddenly, led by a slew of factors. This includes a combination of persistent rise in inflation in Japan, monetary policy normalization by Bank of Japan, expectation of future interest rate hikes, and growing investor concern over Japan's massive fiscal debt. Now, how does rising Japanese government bond yields can impact global markets in India? Japan is one of the world's largest creditor nation and plays a key role in global capital flows. Japanese institutional investors hold substantial amount of foreign bonds, equities and alternative assets. Rising Japanese bond yields will trigger repatriation of Japanese capital. As Japanese yields become more attractive, Japanese investors may sell foreign assets and bring capital back home. This can put downward pressure on prices and upward pressure on yields in overseas bond market, including US, Europe, and emerging markets like India. Rising Japanese bond yields affect India primarily through tighter global liquidity, potential capital outflows, and increased currency volatility, especially in the stock and bond markets. In the US, stronger than expected US non farm payroll figures have also lowered the chances of December rate cut by US Fed. Additionally, concerns over a potential bubble in AI related stocks have further affected investor mood across global market. However, we believe any capital outflow due to AI related stock overvaluation situation can lead to funds flowing back to Indian IT sector, and we are already seeing that happening with the IT index up close to 1.6% for the week. Many stocks are now trading up 200-day and 60-day moving averages. Keep a close watch on stocks like Persistent and Coforge. Nifty trades near record highs. Global brokerages have begun outlining their projections for 2026, highlighting a mix of optimism, earnings recovery, and supportive macro trends. Most of them projected that Indian equities could deliver around 10% annual returns through 2026, assigning a year-end 2026 Nifty target of 28,600. It is highlighted that valuation have turned more reasonable after a long consolidation phase and that earning momentum is reviving. The brokerages also expected bank margins to improve as interest rate ease and lending activity strengthens. Consumer facing sectors, including autos, are also expected to gain from lower interest cost and cuts in goods and services tax (GST). Investors may prioritize sectors with visible earning traction and a renewed interest, such as banking, auto, IT, and consumption, while remaining selective in the other pockets. Technically, the India VIX rose by 13%, indicating heightened volatility and uncertainty among traders. This temporary market stagnation near peak levels reflect a sense of caution among investors amid external uncertainties and specific sector challenges, with global developments and domestic earnings being monitored as crucial factors influencing the market. Going ahead, a decisive close and follow through strengths above all time high of 26,300 would open the door for a revised target of 26,800 in the coming month. We believe sustainability above 26,300 would revive the market sentiment, resulting in broad based participation. Hence, focus should be on accumulating quality stocks backed by strong Q2 earnings, especially from the broader market space, as Nifty Small Cap Index has approached key support threshold level of 200-day moving averages. That's all for today. Wishing you a profitable week ahead. Thank you.